Well, welcome everyone to today's webinar titled Why T-Bills Matter Now, Positioning Cash for Market Resilience and Operational Readiness. This is Brian from Strategic Treasurer, and we're pleased you could join us today. Our speakers for today are Stefan Lintner, CEO and co-founder of GECO, Xavier Audibert, Chief Product Officer at GECO, and Craig Jeffrey, founder and managing partner of Strategic Treasurer. Welcome, Stefan, Xavier, and Craig, and I'll now turn the presentation over to you.
Thank you so much, Brian. It's good to be here. Thanks for the intro, and welcome everyone. Stefan, Xavier, and I want to add our welcome to you. Thank you for spending some time on your afternoon or your evening or late morning, wherever you are. So thanks for investing some of that time with us. And Stefan and Xavier, good to be with you.
Thank you.
Thanks for inviting us. Pleasure to meet everyone today.
We have a lot of content today. This is going to be good. Let me give you an overview of what we're covering. You can see the 6 rectangles. That is our agenda. We're going to begin on the economic situation, and really that's going to focus on, historically, the risk and economic situation can be smooth, it can be a bit choppy, it can be extreme. And this is really a context for being prepared, even when things are smooth or when they're a little bit choppy. Extreme situations can arise, and that's when risk management really pays off. Then we'll look at financial institutions, some failures and risk. We're going to review some of the sizable as well as regular failures that have occurred. And this is for perspective. It's not to scare people, it's not to lull people into a sense of no fear, but to show what happens over time and why we need to be careful with diversification and managing risk. Then we'll move over to cash instruments. Many of us are responsible for handling our short-term financial instruments. We'll look at things like cash, commercial paper, money market funds, broker deposits, and T-bills. We'll probably spend a little bit more on T-bills, but that's all in the context of short-term. And then our next box, of course, is T-bills. Diversification has long been a strength and long been a good strategy for organizations. And so we'll look at T-bills as part of your diversification strategy for both yield, liquidity, and managing the risks that exist. And then as part of managing, how can you manage T-bills? What's changed over time? Technology has shifted how we do almost everything, from managing money market funds to what we do on our desktops to how we work. And so improving the methodology from complex and friction-filled activities on the investment side to looking at ways and developments that have improved or decreased the level of friction that exists. And then for key takeaways, each of us will share one takeaway at the end to leave you with that. So that's our agenda. We have a lot to cover. But to kick it off, Stefan, maybe you could give us a quick summary of what's going on economically, both in current and maybe some historical.
Sure. I mean, the economy is always unpredictable, as we all know. We don't think there's inflation, and then suddenly inflation kicks in. We think everything's stable, and then suddenly things are not stable. You can think of 2008, or you can look at 2023, where SVB collapsed, and nobody really expected any of that to happen. I think Credit Suisse collapsed the same year as well and was just absorbed. So things are always uncertain. And right now there's a lot of, our world is shifting. There's a lot of uncertainty everywhere, although the economy is hot and certain sectors are growing really, 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 really fast. So if you look at the factors on the left, from geopolitical tensions, policy, uncertainty in particular, right now there's a lot of global, and we're talking global here because there's repercussions left and right, tariffs, no tariffs. So what does it mean in general for the economy? It's hard to tell. There's projected growth. There's also just risk that things don't go the way they're planned. and I think the word that we're hearing a lot from our clients is uncertainty. It's what does this mean? What should we focus on in general, which applies, of course, as well to cash management.
Yeah, excellent. And love to hear you step through, when we think about this span of almost 20 years, what's occurred. You do this quick review, and it's all these bad memories come up. But maybe you could talk us through some of
Yeah.
the larger bank failures.
And so maybe just as a matter of introduction, I'm a former mathematician. I was hired by Goldman Sachs in 2007 to price some of the most complicated derivatives. So my first real exposure to the financial world was 2008. Um, I still remember the madness of that, and especially discovering it from the outside, not being trained on Treasury or finance, and just seeing. And Goldman's not on the list of 2008, but we're that close, like everyone else. You may remember City stock trading at $1. Wachovia disappeared, and I don't think that one's listed there. There was, in a matter of weeks only, it was earth-shattering. Just you didn't know which institution would hold, which one would be actually working the next morning. At Goldman, there was a fear of our repo lines. They were in the process of shutting down right after Lehman, and I was part of the team looking at that. And then it didn't stop there. 2009 had failure after failure. Sheila Bair, who's one of our advisors, was running the FDIC at that moment. They almost run out of cash at the FDIC. Now, the good news is if the FDIC runs out of money, they're backed by the U.S. Treasury. We'll talk a little bit more about the U.S. Treasury today, but that's really the source of strength for all of that. It was a big big and crazy aftermath that lasted well into 2012. It wasn't until 2017 or so that regulators were even willing to reissue new bank charters. We were one of the first one to get one in 2020. So the ripple effects and inflation was long, and you'd think we would have learned lessons, but there's still got 23. We had more failures, and those were smaller. There were still large regional banks, and including Credit Suisse, which is not on the list here, but that one just was absorbed in one weekend, just like that, and now it's part of UBS. So if failures happen, they continue to happen. Not all there's the isolated. So usually the real risk is when it goes systemic, and there's what they call contagion risk, and things jump from one to the other. That's really the risk that's no one's prepared for, and we may talk a little bit more going forward.
Excellent. Thanks for the history lesson and some of the context there. That's a great time to start, or a bad time to start. Xavier, this is an opportunity for a case study on some of the failures now, 17 years in the past, but we've seen some other ones more recent. Maybe you could talk us through what the overall broader impact was.
Yes, and so Stefan was referring to systematic risks, and because usually these crises, they start locally and then they spread across institutions, markets, and products. So here we have a list of investment products, liquidity management products, and all of them, when we look at them, money market funds, sweep accounts, cash pool, they are usually regarded as safe, but actually in that context, they really did not behave as expected. So if we go through like some money market fund throws, meaning funds that were supposedly same day started imposing redemption dates. There were bank withdrawal restrictions. So some banks that were stressed, what they did was slowing down and limiting the outflows. So withdrawals or third-party payments. If you were holding CPs, you could not sell them. So you had to wait for the maturity. So they were not cash equivalent as they were supposed to be. It happened as well that some sweep accounts were limited. So you were just, you had balances trapped in investment vehicles. And some cash pools were blocked. So it means that as a company, you just would not be able to mobilize the liquidity across your group. So all of that coming from the fact that counterparties starting questioning each other's solvency. So they were, before making any, a decision, a move, they were waiting to see the moves of the other one. So that was slowing down everything, including some deposits maturity that were supposed to land today, but actually that had to wait days or months, or days or more. So the big message here being that we take it for granted that liquidity is available when we need it, but we say that it was not the case. And today it wouldn't be the case either.
Yeah, that's a good point. It's like I have it, but I don't need it. I have it, but I don't need it when I need it. If it's not there, that's the big fear, right? And that's
Yes.
That's the question.
yeah. And it's good to know as we look back historically, sometimes people say certain situations could never reoccur. And the situations may be different, but there's turmoil, there's challenges, there's rapid shifts that exist. But I want to hear from all of you. We have our first poll question up. This is select one. And the discussion is, how prepared is your organization for a scenario where liquidity gates or withdrawal restrictions are triggered? You have diversification laid in there. You've laid out a plan formally. It's partially there. Maybe it's informal. You have it in your head. How ready is your team for doing that? So you select one, hit submit, and we'll go from there. So go ahead and answer those. If you're done in the chat box, there's the ability to follow Chico on LinkedIn and Strategic Treasury. We'd encourage you to click in there, maybe right click so it pops up in another window, and follow our company so that we can stay connected. And I think people know what my trick is, right? If you're interested in seeing all the results from the poll question, type in GECO. If we get 100 people typing in GECO, especially if it's spelled correctly, that counts fully. Then we'll share the results of all the polls in the deck when it goes out. So the poll question slide will show the results for you. And we know people like data. And if you like data, type in GECO, and that will be excellent. And when it's done, when everybody submitted, here's the answers. And so Xavier, Stefan, I'll just say a couple things. Feel free to make comments. Fully prepared with a documented plan, about 1 in 7, 15%. So not too bad. Partially prepared, but gaps remain. 37%. That puts us at 52%. Aware of the risk, but not prepared or not prepared at all, 18 and 4. And then unsure. I would say unsure likely means certainly not fully prepared. Any comments on this? Either of you?
Oh, just we missed that by 85% not fully prepared. So it means that we will acknowledge that there's a lot to be done in terms of review, of the current investment products.
I'm not surprised by the comment, if I may, because having talked to a number of treasurers, it's not easy when you're in a treasury function. You're understaffed. You have problems to solve every day. Getting ready for the earthquake is, for those of you who live in California, you know what it's like. You're supposed to have everything ready at home, and then it's, I'll do it tomorrow, because there's all these other things coming in. So I'm not surprised. It's still a very low number if you think of it.
Yeah. And moving from informally prepared to formally prepared, documenting that, and then putting those things in place, it requires some effort, but not a massive amount. It does definitely require some preparation. So
ideally some testing. It's like you don't just document it, but ideally you test your plan, make sure it's actually working. You're able to, it's real business continuity planning if you think of it. So that requires dedicating a little bit of time and making sure wires and other things go out and everything's set up so that you can operate.
Yeah, thanks for your comments, and thanks everybody for taking our first poll question. So this slide is more conceptual than don't try to memorize all the spots where things are sitting there. I think we know the Fed just reduced rates by 25 basis points yesterday. So this slide was prepared before they made the drop. But anyway, this is really meant to show a couple examples. This slide talks about duration and yield. It's focused on parts of the safety, liquidity, and yield perspective. The next slide will go into some of the short-term instruments and go into some additional detail. But the purpose here is if we look at the short-term cash end of the cycle, hopefully you can see my mouse. If you are keeping your cash in an account at the bank, you might be earning, earnings credit rate, maybe earning some hard interest, but typically it's sitting down here in this 1% type range. And then, there's all the other aspects of how much you keep in your operating accounts. Then if you look up at the top section, you got commercial paper with individual issuers that can go out to a year. Money market funds could be handling different types of instruments. It could be in T-bills, it could be with commercial paper, a combination. And then you've got the broker deposits, which have a higher yield than typically ECR. They're diversifying those into different accounts. And then you have T-bills, T-bills going out to a year. We've got the orange section there. There's a focus on 1 month. This is a strategy that organizations use. I do know GECO uses that for some of their activities if it's a default, but you can buy T-bills out to a longer period of time. But you can see the yield differential, the duration aspect, and then roughly where the rates sit. These will have to be adjusted by day. So this is more of a general concept for that. I'll just slide on to the next one. We've got now we've got a more detailed list, and you will get the handouts from this. I'll cover the top half, and Stefan will take the bottom. So just a couple items on here to think about where you are as you manage short-term cash. What exists? So you keep the money in the bank account. If you have a certain volume or activity, you get an earnings credit rate from your bank. That can vary to different levels. Where's the coverage? You got FDIC insurance up to $250,000 at a particular bank for a particular entity, right? And interest is based upon, offsetting your commercial charges, your cash management charges. You can get hard interest too at some accounts. Broker deposits is a way of putting these with a brokering entity that shifts these to different entities, shifts them to different banks, and the goal and the process is it keeps all of the deposits under $250,000 for your name. If you have $25 million, it spread them out over, 100 banks and so forth, so that you still have coverage. And so there's the strengths and challenges of that. May take a day to get your funds out, but you may have a limit. If you have a lot of cash, they may not be able to spread it out to enough banks, and so you have an overage that you have to make a decision with. A commercial paper is investing in companies. The high quality companies issue their own commercial paper. You buy those. There's no real insurance or guarantee that exists. If the issuer defaults, which shouldn't be the case in certainly normal times because they're usually highly rated, banks are evaluating them. There's an overall process. But in times of turbulence, what can happen? There can be a secondary market freeze. You may end up having to hold these until the commercial paper markets unfreeze, right? We've seen those things happen. So those are some of the top three. Every situation, every environment creates challenges, and that's one of the reasons why everyone thinks diversification is a great strategy, because it is. But those are the couple of top things. Stefan, feel free to jump in and add on any of that, or start covering the bottom section if you'd like.
Yeah, I think at least in the context of the United States, right? All of the above existed before we had the Fed, or not really money market funds. Those came a little later, but really it's the private markets wrapped around really stuff that the U.S. Treasury does, which is the bottom instrument, T-bills, and those have a long history to Treasury bonds. Not for a long time, not really associated with something you can actually spend against. The T-bills, if you want them today, it's mostly Treasury Direct. The government makes them available directly to you. They're the good part on this one. You have direct exposure to the U.S. government. That's literally the source of money. It's the U.S. Treasury. When the Fed does intervention, it's always about buying and selling T-bills. Everything somewhere involves a T-bill behind. And so there are ways for treasurers to get access to them directly. Most notable, and the one that's free, is absolutely free, is to go directly to the government's website. Now, the problem is that those are not they count as cash equivalent. They're not easy to act on, especially if things are complicated in the market, because you don't have access. There's all sorts of restriction on the government's website. So you can't just sell them there, get cash out, wire up in an emergency situation where all the other banks are failing. You can't act on this. That cash is really an investment vehicle, not available for day to day. This is why we're separated the two bottom parts. The ideal state, the thing that we see our clients ask us, that Warren Buffett has, is T-bills that you can directly own but that are automated, or you have the scale to actually roll them automatically and have access to them where you can liquidate them at any time in the market and get cash out. That's a little bit of an ideal state, the holy grail that gives you both the direct access to the government and yet the ability to, without overloading your treasury team and hiring an army of traders, because those are securities, the ability to have that cash on hand available and spendable across all your different units.
I think that was great. You know, the friction aspect of like automatically rolling them as opposed to the multi-step process of something matures, it becomes cash. Now I'm doing another purchase. That's an efficiency thing, sort of like broker deposits. If you said, I don't want to have balances above the 250,000 level or whatever the level is, and you had to send payments to 250 or to 100 banks, the management of that it overwhelms any of the benefits that exist. And so the element of having these instruments, managing them efficiently and effectively is quite vital. But there's other risks that exist here, structural risk or operational risk. And Xavier, maybe you could talk us through the top sections. And I know Stéphane's going to cover some of the stress test aspects.
Yeah, sure. So let's start so on the left, we have the money market funds. And let's look on that slide at causes and, well, for you as finance teams, consequences. So if we look at the money market funds, causes being that you have an indirect ownership to assets. You do not have a direct ownership. So you own shares in the money market funds, which itself owns the assets. As a result, you are delegating your decision, and your destiny to somebody else. And besides the money market funds, they use repos. It means that the cash that you invest, they lend it to counterparties, and they get, securities in exchange with a return coming with the securities. But it means that they expect to receive a cash back, which may not occur under stressed market conditions. So consequences are that these commingled funds expose you as an investor to the behavior and stress of the other investors. So if you are the only one to be willing to withdraw your funds, okay, there won't be any issue. But if all of you want to withdraw at the same time, then it's where you will be exposed to, that's the last bullet point, the restriction, which are written in the contract of the money market fund, which are the daily liquidity assets, the DLA, which is the acronym, and the weekly liquidity assets, which are two thresholds, which are percentages, which means, for instance, that you may only be able to withdraw up to 65% for the current day, and maybe another 5% by the end of the week, So that's a big cap on the withdrawal you can make. If we look at the bank deposits, causes, okay, known, you mentioned it, the FTIC insurance covering only up to 250K, but also the fact that banks must maintain capital ratios. So what are the consequences? Let's say I'm a bank and I see a very large and sudden, outflow as a result. And if I'm, very close to the regulatory minimum regarding my capital ratio, I will limit all the outflows to not miss, my obligations regarding the capital ratio. So this is where I will be imposing some redemption gates, delaying withdrawals, and third-party payments. And Stéphane, you may want to comment.
Yeah.
Financing should be stress testing the cash instruments.
That's really the hard part in all this is, to Craig's point, you never know what the next crisis. First of all, we don't even know if there will be one. We're not here to fear-mongering at all. It doesn't look like there's one necessarily, but the whole point is you never know when they can happen. And when the financial markets get shaken, you just don't know which institution will hold. What we do know when you do stress testing, you really want to look about all the different wrapping structures and eliminate all that if you can, and then really start thinking about where's the money eventually going to come out when I have to do a payment. It's which bank will it clear through, because you may have the money market funds. Where do you have those? if you look at 2023, some clients had money in money market fund at SVB. So their cash on paper was safe, plus the government bailed out SVB later. But the day off, it was still entitled to the wire room. So the question really, and this is something we may want to talk later on some other topics, is the risks around the wire rooms. How do those work, and which wire room will the money actually clear through? Because if the fund is held at a broker that goes through a small bank, you may have more risk on that. Even if the investment technically is safe, liquidating on that day is going to be tricky. So stress testing and thinking about really doing that disaster analysis, which is something our team gets asked to do a lot, is important when you start looking at where you have your cash or you cash instruments and testing and the cutoffs, reading the fine print. Will this fund give me 100% of my cash the day of, or only 65% and 35% in a week if there's a problem? Because that's very often in the prospectus. So read the prospectus, understand which bank will actually be involved in the wire when you need it, and try to map out a little bit your true liquidity exposure, less than counterparty risk.
Yeah, thanks for that, both of you. And Stefan, I think you just you outlined another webinar we need to have.
Yeah, let's do it.
That was good. A couple of questions in the chat box. Or actually, there's three. One was, what criteria is required for automatically rolled T-bills? You have to have a system that does that. I'm sure GECO will follow up with anybody who's interested in that function, so that it can be an automated process. Dave asked a great question about segmenting the pool. That's going to be more than we can cover today. Those are great questions, but we won't be able to handle that during the webinar. But thank you for asking that. And Steve asked a question about CDARS. That's a specific name for broker deposits, as I was referring to what we call the general category there. And so that's the flow of short-term assets. So thanks for those questions. Those are great. Keep them coming. We really appreciate it. And now we have a question for you. It's a poll question. This is a select all that apply. Which cash instruments in your current mix have you formally stress tested for counterparty and liquidity risk? So this is formally stress tested, not thought about it, but actually formally tested it. Bank deposits, money market funds, CP, T-bills, sweep structures, none of the above, other, or insured. So select all that apply, and we'll be back with you on that in a moment. Give everybody a moment, and I've got a few announcements. I know more people are still completing it. I can't see the answers, but we'll give Stefan and Xavier a chance to respond to those when that comes up. But we do need 40 more people to type in GECO in the chat box. You had just looking for 100. If everybody participates, we'll have that in a heartbeat, because we have way more people. But it's awesome. Like how people type some names in. It's awesome. But there we go. So we're on our way. Plus, this gives Brian Weeks an opportunity.
Well, Craig, as far as the questions are concerned, I know we don't have time to go in depth, but yes, clients are welcome to reach out to us. We do have the systems and the capabilities to solve for what was asked on the automation and the liquidity against it. So feel free to reach out. The core answer is it can be done. We can explain how on subsequent calls.
Oh, awesome. Yeah, of course. Certainly that would be great. So we'll share contact information at the end as well, so you have that. Yeah, excellent point. And yeah, so here is the formally testing. Looks like bank deposits far and away number one, money market funds number two at just over a quarter. Everything else is under 15%. So I think this ties into what you were saying, Stefan, that it needs to be tested, and not as many people are ready for testing. Yeah, awesome. Well, good to know. So that can be an action item for everybody. But Stefan, can you take us through some of the fundamentals of the T-bill markets? Some people are extremely familiar. Others know almost nothing. There's a huge number of us who sit somewhere in the middle.
So let's zoom on T-bills, because after all, that's the whole purpose of the webinar is T-bills, and why now? T-bills are securities, so they're short-term bonds issued by the U.S. government to fund short-term operations. They're the risk-free assets. So you're facing the U.S. government. So in theory, it's a risk-free asset. It's wonderful. The practice is it's a security. So to buy it, you need to somehow go through a broker. There's a bid ask. You have to if you really do it the old school way, you call a broker, you pick your QSIP, and you're doing a trade, you're going to get a confirm, and it settles T+1. That's why it's daunting, and that's why most corporates don't do it, because you're not necessarily even set up to call a broker. You need to have a brokerage relationship, and if you hire a trader, the trader most likely will get bored rolling bills all the day, and the main thing they're going to start asking is, yeah, I'd also like to trade this and that, and I can generate alpha, because that's what traders do, and you don't want that in your treasury team. And so you've got what's ironic about T-bills, they're the safest instrument, and yet they're very cumbersome and complicated to get into, because they're a security, which is why historically people have relied on money market funds, which are a wrapper around T-bills. Kind of makes it easier, and it's not regulated the same way. So they're very pure instruments. They're very short term. The ones that there's 1 month or less, those are cash equivalent, depending on your rules. Sometimes it's less than 3 months, if you're lucky as a corporate. But anything above 3 months starts to become an investment. T-bills are really anything between a month and a year. And so they get issued by the U.S. government. There's something you may want to know about is on the rough versus on the run versus off the run. Every week there's new T-bills being issued. And so the latest ones, the on the runs, are the most liquid ones. They're the ones that are really easy to trade. The off the runs, a little bit less. So if you have a bond that's expiring in 3 weeks but was issued 52 minus 3, 49 weeks ago, not everyone's buying it or selling it today, so it may have a slightly wider bid ask. And so one of the things you want to think about when you're trading them is, what are my costs? When I call the broker, are they giving me a fair price? We see that a lot. Clients think they're getting a good deal, and then they look at their executions, if they look, and realize that, whoops, the traders took somewhere at any bank actually took some spread. I don't want to name anyone. I wasn't implying anything about this bank in particular. Just that devil's in the detail. You're trading a security, and that makes it cumbersome. Because if it's short term, it means there's always something rolling, and God forbid you have multiple entities in your group, and you have something, and you're trying to earmark stuff for account receivable or account payable using T-bills. You got to trade all day long. It's complicated, but it's possible. Mechanically, it's there because there's a very active secondary market. You don't have to hold them to maturity. That's an interesting concept that very often people have. They think T-bills, it's an investment, I have to hold it. The ultra short term, they're just absolutely liquid. You can trade billions at a clip in the market, and you're not moving the market. It's not like dumping a position of stock. You just keep it nice, and the market knows exactly where they should price. There's very, very deep liquidity in the market. And so the secondary trading is, hey, that's what banks do all day long. And that's, again, another webinar we should have. How does the wire room work at a bank? What they do is they sell T-bills. That's how they free up cash, or they repo it. So it all boils back down to that very, very active interbroker, interbank secondary market that's there for T-bills, one of the deepest in the world.
Right, excellent. And we're going to flip over to building resilience. Xavier, maybe you could continue the conversation. And as you step through this, I'm going to bring in some of the questions we've seen pop up in the Q&A and in the chat box. So go ahead.
Yeah, thank you. And there is some complexity unless you use the proper solution to trade and hold T-bills. But there's very strong value to hold T-bills. And here we speak about how they will improve your resilience and the operational continuity of your company. So let's look at the first item. So I said you have, through the T-bills, the direct ownership of the assets. So you reduce it, actually you eliminate any reliance on a fund or any other type of intermediary, which is taking, away your control of your liquidity. So bottom line, you, through the T-bills, can decide which percentage of your assets you can convert in cash and when. So you keep a full control of your liquidity. Second part, you also eliminate the counterparty risk because you shift the exposure away from your traditional banking relationships. What is key here is that should your banking partner face internal stress, your T-bills remain segregated and accessible through the custodian. So in the worst case scenario, where your banking partner, boom, goes away, if we were going back to the slide about 2008, 9, 12, 23, your name is still, registered for your T-bills at the custodian level. So fully independent from these bank failures. The third point is that T-bills also eliminate the uncertainty about the timeline of settlements because T-bills, at maturity, they pay the full sale value directly and automatically. So they provide clearly defined cash return dates. And the last thing Stefan mentioned was liquidity, because the market for T-bill is extremely deep and liquid. And even in the case of market turmoil. And by the way, in the situations of crisis, we see that investors, the first type of asset they would run toward are the T-bills. The benefit is that T-bill will give you the ability to convert your holdings to cash rapidly and whenever you need it.
Yeah, thanks. So one of the questions that came up, Ashley sent it in to hosts and panelists who said, would a T-bill still be risk-free if the government shuts down for a greater amount of time than last time? What amount of government shutdown would increase the T-bill risk? I'll start that and then you guys can provide clarity. I think the comment about risk-free is the view that the U.S. federal government will stand behind it. That's considered the least risk that exists. Any short-term instrument, whether it's a deposit in a bank, commercial paper, there's always something where there can be some sort of disruption, systems down, whatever. And so there's always, that's one of the reasons why diversification matters so much. But I'll flip it back over to Stefan and Xavier to maybe say a little bit more on that.
Yeah, when I use the word risk-free, what I was referring to is the economic terms. When economists talk about the risk-free rate, that's what you're getting on a T-bill. This is a good question. The good thing is the government can always, technically, if they all get, whenever there's a shutdown or a debt ceiling conversation, it's usually for political reasons. Eventually, the government has the ability to solve its own debt problem just by increasing the ceiling and or having the Fed intervene in the markets. There's always this ability to create more money. So the only risk really you're taking with this potentially, and our whole system is built around this. Meaning, if there starts to be disruptions in the T-bill market, that means the money market funds get hurt. That means the repo market that funds all the liquidity across all the banks, where the core collateral is always T-bills, gets affected. So the forces at play to keep T-bills liquid and working are literally the entire foundation of our financial system. So is there a scenario one day where the government could technically, for some technical reasons, not default on some short-term bill? Obviously, it's possible. If that happens, I think every single other holding you may have on cash is also going to be at risk because T-bills is the underpinning building block for all of that. And at least there you have the direct exposure to that risk. To Craig's point, though, diversifying is always a good idea.
Yeah, excellent.
And by the way, the FDIC, the insurance, the fund of the FDIC is itself invested in T-bills. So you will not even be protected, by just keeping your cash deposited at a bank, unfortunately.
Yeah. These are good questions. Great answers, too. Appreciate that. So we're going to move to views on T-bills. So this is a couple results from a survey that Chico ran earlier, and Stefan, maybe you could take us through what the perception is. And
so yeah, we when we rolled out our product, we wanted to really understand where it fit in the market, and we showed up at AFP and different conferences and started collecting data from large corporates just to try to understand a little bit how the market was already perceiving T-bills. What's really interesting is all of you, most of you already know that in theory, T-bills are a better, a slightly safer instrument, something you should have as part of your cash holdings at a corporation. Warren Buffett is the ambassador for that. I think Berkshire has 100 billion worth of T-bills on cash. Great. So the market, it was not a surprise. It's a sophisticated market. All of you know what a money market fund and a T-bill is. So we were pleasantly reassured by the fact that there was such an appetite for T-bills in theory. In practice, in practice, the number of treasurers who actually had the direct T-bill holding was much smaller, and the main part of the survey, one of the result was it had to do with the fact that, well, I described it a little bit earlier. Their securities are complicated to get, so it's just given how understaffed Treasury teams are and overwhelmed with all the other risks like cyber and protecting and making sure your accounts don't get hacked and somebody steals your money and wire fraud and all the other things that you have to think about. There's very little time to go buy T-bills and do it. And if you do it once a month, it's 3 hours on the phone with a broker. It's very complicated. So you have this crazy dichotomy between 66% on the one hand, where we agree it should be part of what we do, and only 5% who even think that it's simple because it isn't right now.
Yeah, it hasn't been, right? It's the friction and difficulty. Where I think that's the experience that people are seeing from a historical perspective. Yeah, great explanation. That brings us to poll question number 3. What's your organization's primary focus area as you think about cash management for 2026? Enhancing liquidity access, improving yield, reducing counterparty exposure, simplifying operations and settlement, regulatory or policy alignment, still evaluating, other, or in short. Go ahead and answer those. And I will note that we have enough answers. We've had quite a bit over 100 people type in GECO in the chat box. So thank you for playing along with that. And still people will type more. So all those extra GECOs maybe we can apply to the next webinar that we do, Stefan. It's awesome.
There's one bullet missing here, is using AI to make my life simple. I thought that was the theme for treasurers and cash. Everything's AI these days, right?
I guess we could have made that longer. Yeah, it's good stuff. So yeah, if everybody goes and answers that.
Hey, Craig, I see there's an anonymous question. I don't know if you saw it, for will there be any potential methods explained in the webinar for stress testing? I don't think we have that on the list for today, but that's something we can follow up on as well, or maybe there's another webinar for that.
Yeah, there would be. You want to start? You want me to start with something simple on that just to get it going, just to prime the pump for a later webinar, maybe?
Yeah.
Yeah. So I guess, when you think about stress testing, it's if you look at, you use these 4 things for liquidity, these bank accounts, purchases of commercial paper, money market funds, direct ownership and T-bills, whatever the methods you have, you can create your different stress test scenarios to say, we're not going to have access to this category of assets or this other one or this particular bank, and we have to operate for 2 days or 3 days. And you make sure that you're not counting it towards the rest of your activity, so you don't lose out too much on the funding side. But you see, can you operate and survive? That's probably the simplest starting point for that. I don't know if Stefan or Xavier, you want to say anything else on that?
Yeah, my besides working with us, if you're interested, but typically it starts with taking a couple of days to really block the time and say, okay, let's start listing all our holdings. Let's understand which bank we're going through. And almost tabletop exercise where you role play it and start assuming this doesn't work or this doesn't work, and have 2 teams question each other and really push on what could happen on this and that, and then start understanding. And but for that, you really have to put yourself in the mindset of a 2008. And that's, if you haven't lived through it or you're not too close to it, the complexity in the risks is deep. So it's not so easy to ask those questions. But I would say start reading the fine prints and understanding where the money flows for each and every potential source of cash. What would it take to liquidate at size? Can it go through? And what's the risk that the counterparties involved depend on each other.
Yeah. So thanks for that second level explanation on that. So for those who might be interested in a webinar on exploring stress testing your short-term liquidity portfolio, type in stress test or stress. We'll just see how many people are interested, and if there's enough interest, we'll make sure we get something scheduled. I think it certainly sounds fun and useful to explore the next level and then go from there. Any comments, Xavier or Stefan, on the cash management focus? Number one was enhancing liquidity access. Number two, as our big and read, is improving yield. Any thoughts on this before we move on?
I find it fascinating. Very often people think that treasurers are just thinking about yield all day long, and it's really only a focus for 21%, and that makes sense because first of all, most of these instruments are roughly giving you the same yield. There's some outperformance here and there, devil's in the details, state taxes, all this other stuff, but really, when you're in the treasury function, it's as everyone knows, you don't get fired for not making too much yield. It's really a question of have you protected the cash? Your job's to protect the cash, and so I'm not surprised to see that. I'm also not surprised to see that there's a fair amount of people focused on making their workflows simpler. So that's where we have empathy. We know how hard that is, and that makes sense given how digital and more complex our world is getting. So I'm not surprised to see both of those numbers.
Xavier, your mic is off.
Yes, if you want to improve yield and simplify at the same time in the context of the T-bills, you would like some platform that would automatically roll, for instance, the T-bill so that your percentage of days invested in the year is 100%. So in that case, you can hit both the simplification and yield and liquidity access for the resilience of the T-bill that we were mentioning before.
Excellent. I'm certainly appreciate everybody asking the questions, and I'm certainly enjoying the conversation points that are unscripted by Xavier and Stefan. So, not much remains unaltered when different different technologies is applied. So maybe, Stefan, could you talk us through some of how T-bill trading has traditionally worked? What are some of the situations and friction that exist?
Yes, and I alluded to this a little earlier. Look, again, it's a security. So normally to access a security, you need to have a brokerage account with a broker, which offers you everything under the most investment possible because they make most margin on everything else but T-bills. T-bills is the lowest margin instrument, not the exciting one to sell to someone, but it's kind of an all or none combo. You open a brokerage account and now you have to make trading decisions. And so that means calling. It means picking a QSIP. QSIP is the identifier. So that alone means that you're able to decide which T-bill do you want to buy. The one that was issued 3 months ago and has 2.5 weeks left of shelf life, or the latest on the run that was just issued a day ago and has 4 weeks of shelf life. That's not the decision you want to be thinking about every day when you wake up. You have everything else to do. And then the broker on the other side will quote you a price. 99.9923. Is it 23 fair? Am I getting what is he paying on the other side? You don't know. You don't have access to Bloomberg. Most likely you don't have access to the tape. And so that's the pricing, the opacity around the pricing. And then there's another thing that will happen if you do look at your confirm again, you don't just see the price. You don't know if it was a good price because no one's showing you the market. They'll just show you what you executed at. Which, again, that's how brokerage firms work. But in your case, literally every basis point or sub basis point eats into your yield. You want to really know that you want transparency. You want to know that things are tight. At the same time, you don't want to spend a lot of time doing all this, especially if you have multiple accounts or multiple entities you're managing. And if you're trying to be risk averse, you're going to be mostly in 1 month or less bills, which means things are rolling almost weekly. If not twice a week, because some are issued on Tuesdays, others on Thursdays, and so there's a lot of manual steps everywhere to make that work. Which is why typically those who do have T-bills, they do it in one pooled account at the top, or they pay an SMA if they're large, separately managed accounts. You pay people to do that, but then again, they won't do just T-bills. It's going to be all sorts of other investments, commercial paper, the longer dated treasuries, and then it becomes really an investment. That's the stat. This is what traditionally looks like. The idea that you could use T-bills as an ultra short-term cash resilient solution for cash management is kind of new, because historically it's just been an opaque and complex market designed for size, for the large banks, for the brokers amongst each other to trade large amounts of liquidity. They have people on staff. They all know what the right price is. They talk to each other, and they trade it late into the day when you have to deal sometimes with cutoffs. And then the worst is when you get your statements, there's all these trades that has to flow somewhere. So if it's an investment and you don't have that in your policy, you have to get it approved, and then it has to flow to your TMS or your other systems. That's historically the barrier around T-bill. Never been impossible. It's just usually not worth the extra effort on a day-to-day basis because of the work involved.
Yeah, or it's worth it for certain companies that have huge holdings and can afford lining up a number of people to it. But it's certainly, like you said, opaque and challenging. I'm going to take a cut at the reducing the friction side, talking about that, and feel free to jump in to help me out. What are some of the developments that are taking place that help reduce that friction? One is a T-bill sweep account. So as Stefan had mentioned, normally you have to send money into a brokerage account, then you do the trade. You do all these multiple steps. Well, a T-bill sweep account is an account where you send the money in and it gets invested automatically. It starts buying. Let's say if your instructions are short-term T-bills, it buys them. You've got the rules for how it operates, and the ownership it's direct. It's not shared. We talked about certain financial instruments or financial tools where you invest and you're exposed to other people in the pool, and you're subject to, if they redeem things, your underlying assets that you share may be sold and changing your performance, your activity, and affecting how much liquidity you have. So this allows for that direct T-bill ownership. It's handled, it's held, gives you current yields. And so the same holds true when you need to pull money out. You wire funds out. You don't have to go, I have to sell it, gets in the account, I move it out of my brokerage account to a demand deposit account, then I wire the funds. Like, all those extra steps are, almost all of them are automated. So there's, you're eliminating the friction points. So that's a pretty interesting development, we believe, for the current environment, to take advantage of the T-bill environment and the benefits while reducing the friction side. And so that's a key part there on the right hand side. Hey, I think I already spoke to some of that, right? You pay right out of the account. It comes directly from there. You don't have to do the multiple step. You can have people send money to you that doesn't have to go to a collection account, to your concentration account, swept to an investment account, or swept to an account, a brokerage account that you provide instructions for moving. It moves it to investment as quickly as possible. And you just eliminate some of the steps. And so efficiency is what's automated and what's eliminated. So this is a combination of automating and eliminating steps that make life easier. So those are some of the key methods for T-bill management.
Craig, if I may, the question we get a lot is, why is this coming now? What makes these developments possible? Because if you think of it, T-bills were already here in the 90s. We had internet in the 90s. We had computers in the 90s. Where is this product? Why are these types of products rolling out now? And a lot of it has to do with all the progress that have been made in the trading infrastructure, the trading world. Equities got went decimal at the beginning of this century, and electronic trading for equities is something all of you are used to. Whether you're using Schwab, Fidelity, or Robinhood, or public.com, or by now, or even crypto, you see the speed at which the investment world works there. It's really so it's possible to trade way more sophisticated products than T-bills automatically, or at least on a click of a button, and all of that fractionalized even for retail, lots of retail accounts. What's interesting is how that's now percolating into the corporate world, bringing, without the madness of retail and meme stocks and all of that, keep that away. Just this solidity of institutional settlement and trading now being being integratable within banking because there's also more digital banking. When you start putting the two together, that's when these kind of products start to emerge, and it's interesting to see that happen now when 15 years ago or 20 years ago, it sounded absolutely impossible.
It's a good time to be alive in the Treasury. So here are our final thoughts. We'll go Xavier, myself, and then Stefan.
So regarding our primary and last actually considerations, so obviously to review the mix of instruments that you use to invest your cash, like obviously safety, liquidity, yield, efficiency, and the structure. And when we speak about liquidity, it's not only, okay, capital preservation, it's also obviously the delay to get the cash back. And can you ensure uninterrupted access to your cash? And actually, we see that not many instruments offer it. But we understand that, with the pressure on the headcount, budget for finance teams, efficiency matters so much. That's why I like very much what you were presenting, Craig, before. Like when, compared to like a deposit you make into a money market fund, if you can just have to make a deposit to get, your funds invested into some other instruments. And if that invested account can be used to directly pay third parties, that does change a lot of things for treasury teams, including that reduces the cushion of idle cash that they usually keep, for the unexpected outflows. So that easiness, efficiency do matter so much as well.
The second pillar here is diversify the liquidity stack. I guess we could have said diversify and test. So evaluating counterparty structural risk, have a plan, be formal about that, and actually test it. The other aspect about diversification is, I think if you're on this webinar, you've listened to the discussion, you understand the markets. It may have been too difficult to consider T-bills as part of your mix or use them, but that certainly is a great part of a good diversification strategy for your short-term cash.
Yeah, and then I'll close on examine assumptions. Someone we know really well used to run a big endowment, and they selected a few money market funds, and they would always, in their case, always read the fine prints. And the conclusion they came on is we're thinking we're diversifying, we're putting money in various funds, but when we peel off the documents and actually rebuild our exposure to which banks we're actually funding the repo balance sheet of, because all these funds end up buying repo from the banks. They said we're actually not as diversified as we thought. We're actually concentrated across 3 or 4 large banks. And sometimes you pick up a random bank in Greece, which you didn't even realize you had implicit exposure to some bank in Greece. So don't really examining the assumptions is part of what we encourage everyone to do here. Read it. The curveballs will always come from where you don't expect them, is when things look fine and you haven't looked at it in a while. That's where you may have some risk lurking.
Excellent. Well, thank you, Stefan, Xavier, and everyone for joining. I'm going to pop up a screen where there's some additional contact information and data, and I'll turn it back over to Brian. Thank you.
Thank you, Greg.
Indeed. Thank you, everyone, for joining us today. The CTP credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on all things Treasury, be sure to listen to the Treasury Update podcast by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.